Are you tired of seeing your gains disappear or losses pile up when market moves against you? In this video, we'll show you how different stop limit orders can help you manage risk, even when you're not watching. A stop limit order is a conditional order to buy or sell a stock that is executed only if the stock price reaches a level you've set. With these orders, you enter a stop price and your order is triggered once the stock hits that price. A stop limit order has two inputs: the stop price, which triggers the order, and the limit price, which sets the minimum you're willing to sell for or the maximum you'll pay if buying. The order will only execute if both conditions are met, giving you control over price, but with the risk that the order may not be filled. If you're selling, this means you're protected from selling at a much lower price than expected, but you also might miss the chance to sell at all. Let's look at an example. Say you own a stock trading at $50. You expect the price to fall and want to sell it for no less than $47. You set a stop price at $48 and a limit price to sell at $47. If the stock drops to $48, your order is triggered. You've automated your exit, but still controlled your price. Keep in mind, the order might not fill at all if your limit price of $47 isn't met or not enough shares are trading at that price. This kind of order can help you avoid emotional decisions and are often used to help limit losses or protect gains. They can also be used to buy a stock if the price rises to a certain level. For example, when you want to enter a trade after the stock shows upward momentum. Next up, let's talk about a trailing stop limit order, which builds even more flexibility into your exit strategy. This order type allows you to specify a limit on your maximum desired loss without setting a limit on your maximum possible gain. For sell orders, it lets your stop price move up as the stock price rises. For buy orders, it helps protect profits while keeping the chance to capture more gains. Here's how it works when you want to sell a stock. You start by choosing a trail amount, in dollars or percent, that determines how far behind the stock's price your stop order will sit. As the stock moves up, your stop price trails it by that amount. If the stock starts to fall, the stop price remains the same. If the price keeps dropping and hits the stop, your order is triggered. You decide how far behind the stock your stop should trail. Tight enough to protect gains or wider to allow for price swings. Once your stop price is set, you'll also choose a limit offset, a set dollar amount or percentage below your stop price. This tells the system the lowest price you're willing to accept when your order is triggered. When that happens, a limit order is placed at the stop price minus the offset. The order will only fill at that price or better. Let's look at two examples with the trailing stop limit. Suppose your stock hits $100 and you've set a 5% trailing stop and a $2 offset. If the stock drops to $95, your stop limit order is triggered and will execute only if your shares can be sold at $93 or better. Let's recap. Your order is triggered at $95 because $100 minus your 5% trailing stop is $95, and your order executed at $93 or better because your $2 offset is subtracted from the $95 where the order was triggered. But imagine a different scenario. Your stock keeps climbing, say to $120. Your stop trails it upward, resetting to $114. If the stock drops to $114, the order is triggered with a limit of $112, helping you lock in more of your gains. Let's recap that as well. Your order is triggered at $114 in this scenario because $120 minus 5% is $114. And your order executes at $112 or better because $114 minus the $2 offset is $112. The trailing stop limit order gives you both automation and price control. You stay in the trade while it's going your way and set clear terms for when it's not. Think of it like climbing a ladder with a safety net moving up behind you. As you reach new heights, the net follows, ready to catch you if you fall, but never getting in your way while you climb. Keep in mind that stop order is only triggered during regular market hours. If your stop is reached outside of those hours, your order will wait until the market reopens. You can also choose how long the orders stay active. Many investors use day orders, which expire at the end of the trading session if not triggered. But you can also set a custom expiry date, giving your order more time to work without having to re-enter it. Let's take a quick look at how these order types compare. A stop limit order executes if the stop is triggered and your price target is met. Great if you're set on getting a certain price. However, the order might go unfilled or partially filled in a fast-moving market. A trailing sell stop limit adjusts your stop upward as the stock rises, then triggers a limit order on a pullback. It helps lock in gains while giving the stock room to move within a range you define. But, like the stop limit order, the order can go unfilled or only partially filled. Both order types help you remove emotion from the equation and stay focused on your trading plan. If you want to learn more about trading smarter, check out the links in the description.